Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Chewy Inc. Annual Report. Chewy Inc. offers a wide range of businesses and services to cater to the needs of pet owners in the United States. At its core, the company provides e-commerce services through its retail websites and mobile applications. This allows customers to browse and purchase various products online with ease. The company's product offerings include pet food and treats, as well as a variety of pet supplies such as toys, grooming tools, and accessories. Additionally, Chewy Inc. also offers pet medications and other health-related products to ensure the well-being of pets. Furthermore, the company provides an AutoShip subscription program, which allows customers to receive regular deliveries of their preferred products. In summary, Chewy Inc.'s businesses and services include e-commerce, pet food and treats, pet supplies, pet medications, and pet services through its retail websites and mobile applications. Chewy Inc. market capitalization of $11 billion is materially smaller than most of its industry peers of roughly $38 billion. Chewy Inc. trades at a higher price-to-earnings ratio of 51 times and a higher price-to-book ratio of 22.16 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 91% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the pet industry can be attributed to several key factors. On the growth side, the rapid shift to online shopping, growing trend of subscription-based purchasing, and increasing adoption of online pet retail have been significant contributors. Expansion into new markets, such as Chewy Canada, has also played a crucial role. Furthermore, the growth in AutoShip customers, increased adoption of CarePlus product suite, and increase in advertising and marketing expenses have all contributed to revenue growth. On the other hand, unsustainable growth rates, failure to manage challenges to future growth, and resistance from veterinarians to authorize prescriptions have been major drivers of revenue decline. Strong competition in the pet products and services health and retail industries has also hindered growth. Additionally, significant merchandise returns or refunds, uncertainties in economic conditions, industry trends, and market conditions have all contributed to revenue decline. It is worth noting that changes in consumer preferences, ability to differentiate product offering and customer experience from competitors, and effectiveness of employee recruitment, hiring, training, and retention on maintaining reputation for exceptional customer service are also important factors to consider. However, these factors do not necessarily drive revenue growth or decline, but rather influence the overall market dynamics. Net income and profit margins. A changing landscape, the net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it increased by 15% from $1.23 billion to $1.41 billion in 2024. However, this growth was short-lived, as the net income decreased in 2024 compared to 2023, $392.7 million versus $39.6 million. The decline continued in 2025, with a decrease of 43.3% from 2024 to 2025, $222.8 million versus $392.7 million. The profit margins also experienced a downward trend. The gross profit margin decreased from 24.5% to 23.8%, while the operating profit margin dropped from 7.2% to 6.9%. Furthermore, the adjusted EBITDA margin declined from 4.8% in 2024 to 5.7% in 2025. The reasons behind these changes are multifaceted. Revenue growth was a contributing factor to the initial increase in net income, but it was not enough to offset the decline in gross profit margins. Various factors such as increased costs, competition, regulatory challenges, and disruptions to supply chain and operations also played a significant role in the decrease in net income and profit margins. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided data, the net cash provided by operating activities has consistently increased over the past 3 years, reaching $691.6 million in 2025. This upward trend is a clear indication of the company's efficiency in managing its operations and generating sufficient cash to meet its financial obligations. The confirmation from multiple sources within the report further solidifies this conclusion. The free cash flow figures for all 3 years also support the notion that the company is indeed generating positive operating cash flow. Furthermore, the explicit statement on page 49 that operating cash flow positive leaves no room for doubt about the company's financial performance. In summary, the data and analysis presented in the report unequivocally demonstrate that the company is successfully generating positive operating cash flow, a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, the total debt has increased from $2,753 million in 2025 to $2,868.5 million in 2026, indicating a rise of approximately $115.5 million. However, it's worth noting that the ABL credit facility principal amount remains at up to $800 million. On the other hand, interest expenses have decreased significantly. In fiscal year 2024, interest income was $35.9 million, but in fiscal year 2025, it dropped to $16 million, a decrease of $19.9 million, or 55.7%. Additionally, interest expenses also saw a decline by $900,000 in 2025 compared to the previous year. These changes suggest that the company's financial situation has improved in terms of its debt and interest expenses. The performance of various segments and regions within the company has been mixed. On the positive side, the pet healthcare segment has seen significant growth through expansion into new services. International markets, particularly Canada, have also performed well, with Chewy Canada's launch in 2023 capitalizing on the country's high pet ownership rate. Additionally, the veterinary clinics segment, Chewy Vet Care, has expanded to 18 locations by 2025. However, other regions and segments have struggled. International markets outside of the US and Canada face challenges due to geopolitical events and sanctions, which may hinder expansion efforts. The rise of internet-based competition poses an ongoing threat to business success, while unfavorable changes in e-commerce regulations could harm the company's operations. Furthermore, the Middle East has experienced poor performance due to similar geopolitical issues. Strong competition from established players in online marketplaces also presents a challenge for the company. Management believes that the company is poised to be the leading online destination for pet products and services. They aim to achieve this by providing exceptional customer service, competitive pricing, and convenience. However, they acknowledge that there are external factors that could impact their success, such as international conflicts and trade uncertainties. To mitigate these risks, management is focused on retaining key personnel and attracting qualified employees to execute the business plan. They also recognize the importance of strategic transactions, including acquisitions, which may require issuing additional equity or incurring debt. The company's growth strategy relies heavily on its ability to differentiate itself from competitors through exceptional customer service and competitive pricing. Management is aware that the pet products and services industry is highly competitive, and they must continue to innovate and adapt to stay ahead of the competition. They intend to retain earnings to finance operations and expansion, rather than declaring dividends in the foreseeable future. Overall, management's outlook for the company is positive, with a focus on delivering exceptional customer service and driving growth through strategic transactions. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has expanded its customer base by acquiring customers who have historically purchased pet products from other retailers. Additionally, it has entered into transactions with affiliates of BC Partners, which were closed on October 30, 2023. Furthermore, a significant acquisition was made in February 2026 when Smart Pack Equine, LLC was acquired for $175 million. On the divestiture side, the company has terminated equity warrants worth $4.9 million in 2025, resulting in a financial gain. The company's financial activities have been quite active in recent times. One notable aspect is its commitment to rewarding shareholders through dividend payments. As per the records, the company has indeed paid dividends, as mentioned on page 77 of the report. In addition to paying dividends, the company has also taken steps to return value to its shareholders by buying back shares. This strategic move not only boosts shareholder confidence, but also helps in maintaining a healthy stock price. The decision to buy back shares is evident across multiple pages, including page 51, 52, and 79 of the report. Supply chain disruptions pose significant risks. The extracted summaries reveal several concerns regarding supply chain disruptions that could potentially affect business operations. One of the primary risks is the loss of key suppliers or disruptions from existing ones, which could lead to shortages and delays, page 13. Additionally, shipping arrangements may be disrupted due to various factors such as inclement weather, labor disputes, or financial difficulties, page 14. Furthermore, third-party data center hosting facilities, telecommunication issues, payment processing disruptions, and cybersecurity incidents are also potential risks that could impact operations, pages 16-17. Suppliers may not adhere to product safety requirements, leading to further complications, page 18. Global conflicts, such as those in the Middle East or Ukraine, may also disrupt global markets and impact supply chains, page 19. These concerns highlight the importance of having contingency plans in place to mitigate potential disruptions. By understanding these risks, businesses can take proactive steps to ensure continuity and minimize the impact on operations. That concludes the financial summary for Chewy Inc. Feel free to comment below, and I will be happy to answer them when possible.